Welcome to Simo Defa Finance, the YouTube channel where we explain finance in quick and simple bites. In early 2021, the stock market witnessed an unprecedented event: the explosive rise of GameStop's stock price. What started as a seemingly ordinary stock turned into a financial phenomenon that captured global attention. Today, we are diving into the incredible story of the GameStop stock explosion. GameStop, a video game retailer, had been struggling for years. With the rise of digital downloads and online competition, its stock was trading at just a few dollars per share. Many investors, particularly large hedge funds, bet against GameStop by short-selling its stock. Short selling involves borrowing shares and selling them, hoping to buy them back at a lower price and pocket the difference. Essentially, these hedge funds were betting on GameStop's failure. Enter r/Wall Street Bets, a community on social media platform Reddit. This group of retail investors, fueled by a mix of financial opportunity and a desire to challenge Wall Street, saw an opportunity. They noticed that GameStop stock was heavily shorted and decided to take action. By collectively buying shares and call options, they aimed to create a short squeeze. A short squeeze occurs when the price of a heavily shorted stock starts rising sharply. Short sellers, facing potentially unlimited losses, are forced to buy back shares to cover their positions, which further drives up the stock price. The result? GameStop stock skyrocketed from around $20 in early January to over $400 at its peak by the end of the month. This dramatic rise was fueled by a combination of social media coordination, the power of retail investors, and a bit of luck. The mainstream media quickly picked up the story, and soon everyone was talking about GameStop. The event even drew the attention of lawmakers and financial regulators, leading to hearings and discussions about market manipulation and the power dynamics between Wall Street and Main Street. During the frenzy, some hedge funds that had heavily shorted GameStop suffered massive losses. On the other hand, many retail investors using platforms like Robinhood saw significant gains. However, the situation also exposed some weaknesses in trading platforms. Robinhood controversially restricted trading of GameStop and other volatile stocks, citing liquidity concerns, which sparked outrage and accusations of protecting Wall Street interests. After reaching its peak, GameStop's stock price eventually fell back down, but the impact of this event was lasting. It sparked debates about market fairness, the role of social media in investing, and the influence of retail investors. For some, it was a financial windfall. For others, a cautionary tale of market volatility. To understand the magnitude of what happened, let's break down short selling and short squeezes. When investors short sell a stock, they borrow shares and sell them at the current price. If the price drops, they buy back the shares at the lower price, return them to the lender, and pocket the difference. However, if the price rises, they face potential unlimited losses because they have to buy back the shares at a higher price. This is where a short squeeze comes into play. When the price of a heavily shorted stock starts rising rapidly, short sellers scramble to buy shares to cover their positions, driving the price even higher. The coordinated effort by Wall Street Bets to buy GameStop shares created a self-reinforcing cycle. As the price climbed, more short sellers were forced to buy back shares, pushing the price up further. This unprecedented move by retail investors highlighted the power of collective action and the influence of social media on the stock market. Financial analysts were both fascinated and alarmed by this event. Some saw it as a democratization of the stock market, where individual investors could take on Wall Street giants. Others warned of the dangers of speculative bubbles and the potential for significant financial losses among inexperienced investors. The GameStop episode became a hot topic on news channels, with experts dissecting the implications and potential repercussions. The GameStop phenomenon didn't just stay in the financial world, it caught the attention of lawmakers and regulators. Congressional hearings were held to investigate the incident, exploring issues such as market manipulation, the role of trading platforms like Robinhood, and the broader implications for market stability. These discussions highlighted the need for updated regulations to address the evolving dynamics of the stock market. After the dust settled, GameStop's stock price stabilized at a higher level than before the surge, but well below its peak. The r/Wall Street Bets community celebrated their victory, but also reflected on the lessons learned. Some investors made significant profits, while others faced losses. The episode served as a reminder of the unpredictable nature of the stock market and the risks involved in speculative trading. The GameStop saga was more than just a stock market story. It was a cultural phenomenon. It demonstrated the power of collective action, the unpredictability of the markets, and the shifting landscape of financial power. Whether you see it as a victory for the little guy or a dangerous precedent, the GameStop explosion will be remembered as a defining moment in financial history. Thank you for watching. If you enjoyed this video, make sure to like, subscribe, and hit the notification bell for more content. See you next time!